And this is something in a business, whether it's small or large or somewhere in between, that you should be doing on a consistent basis. Okay? It's done to find the firm's financial strengths and weaknesses. And this is something that you need to know to build the company. And this is what we're trying to do here, is build the company. Primary tools here are financial statements, of course, the income statement, the statement of owner's equity, and of course the balance sheet. It's comparison of financial ratios to past, to the industry, or to a sector, or maybe all the different firms that are out there. It's really a compare and contrast per se. Financial statements, of course, we know we have the balance sheet, the income statement, and the cash flow statement, and the statement of retained earnings, or the statement of owner's equity. Retained earnings would be basically for a corporation that is publicly traded. Statement of retained earnings is very equal to the statement of owner's equity. Owner's equity would be more for a partnership or a sole proprietorship. Balance sheet, of course, you know, your assets, your liabilities, and the final number for capital. Income statement, revenues minus expenses, either gives you net income or net loss. And then the cash flow statement will give you, in some instances, daily, what money is coming in and what money is going out. And the statement of retained earnings is just what is the money that you retained in the company after taxes. Objectives of ratio analysis standardize financial information for comparisons to make sure that we're doing okay. Evaluate current operations, which is key and important to improving. Compare performance with past performance. Okay, are we getting better? Are we getting worse? Did we stay the same? What's happening? Compare performance against other firms or industry standards. You could compare yourself to firms within our conglomerate, or you can compare it to other firms in your industry, or just industry standards. Okay? And it studies the efficiency of operations. And of course, to be successful today, this is what you need to do. You need to have efficient operations on a consistent basis. And study the risk of operations. There's risk in everything. Doesn't matter what you do, start a new program, start a new project, create a new product, create a new service, there's always going to be risk. So ratio analysis kind of looks at a bunch of stuff. It looks at the financial end of it, which is your financial statements. It will look at profitability, of course, because nobody gets into business to lose money. Nobody. Okay? It could look at the gearing. Are profits going up or are they going down? It's going to look at the investment of shareholders. No one wants to invest in something and lose money. The whole idea to investing in things is to get more money. And then, of course, liquidity. Now, liquidity is important because how fast can you take an asset and turn it into cash? Okay? And that's liquidity. How quickly you can get cash out of any asset. Liquidity, the ability of the firm to pay its way. If you need money, it's very common for companies to sell things. Okay? And how fast can you get the money? For instance, cash is cash. You can get cash as cash. Okay? Buildings take a little longer to get the money. Land, a little longer to get the money because it takes a little bit of time for those types of assets to sell. Investment shareholders, information to enable decisions to be made on the extent of risk and the earning potential of the business investment. Again, nobody's going to invest in any business and want to lose money. Gearing, information on the relationship between the exposure of the business to loans as opposed to share capital. In other words, it could be, it's profit going up, it's profit going down. Should we get loans? Should we itself. Okay? Profitability, of course, is how effective the firm is at generating profits given sales or its capital assets. Capital assets are big assets. Assets such as buildings, land, patents, trademarks, and just cash in the bank. Cash at hand is important. Financial, the rate at which the company sells its stock and the efficiency with which it uses its assets. And the financial part of it comes down to how much money you're making. Because what's going to happen here is once you're doing well and you're making good money, there's going to be more people investing. And that's what we want. Because we can take that investment that the shareholders make and we can use it in operations to make the company better. Liquidity, how solvent is the business? Well, let's look at this. If you have to file bankruptcy tomorrow, could you sell all your assets and pay off all your liabilities? Okay? So that's a big one. And then, of course, we have financial, we have profitability, we have the gearing, we have the investment. There's two tests under that, how solvent the business is, and that's asset test and current ratio, which we're going to talk about here in just a little bit. Okay? As referred to, the asset test is the quick ratio. Current assets minus stock, okay? And it's 1-to-1, seen as ideal. You should have as many current assets as you do stock. The emission of stock gives an indication of the cash the firm has in relation to its liabilities, what it's owed. In other words, do you have the cash or do you have the other assets to pay off all your liabilities if things get bad? Okay? The ratio of 3-to-1, therefore, would suggest the firm has 3 times as much cash as it owes, and that would make them very happy. Most banks and most investors, they like this asset test at about 2-to-1. Because they know if anything happens, there's a good chance that they're going to get their money back. Okay? A ratio of 0.5-to-1 would suggest the firm has twice as many liabilities as it has cash to pay for those liabilities. This might put the firm under pressure, but it's not in itself the end of the world. Okay? It's not, but a lot of investors, a lot of banks would not loan to somebody with an asset test like that. And a lot of investors would not invest if they saw it like that, because they would go, oh my goodness, if something happens, we're not going to get any of our money back. The current ratio is one that is used a lot. It looks at the ratio between current assets and current liabilities. Current assets equals, or what is it, to current liabilities. Ideal level is 1.5-to-1. In other words, you have 1.5 assets to 1 liability. But the best one, and the one that the banks and investors are looking at, is a 2-to-1. Now we want 2 assets to every 1 liability. Okay? This would imply the firm has $5 of assets to every $1 in liabilities. 5-to-1. So that means they're in pretty good shape. 0.75-to-1 would suggest the firm has only 75 in assets and dollars available to cover every $1 it owes. So they may not be able to cover the money. They may not be able to cover all the liabilities that they have. Too high might suggest that too much of its assets are tied up in unproductive activities. Too much stock, for example. That can be a problem too. Okay? Why are you not taking that cash or those assets and using them to make more money? Okay? Too low, risk of not being able to pay your way, pay off your liabilities, pay your bills. Okay? Investment of shareholders, we can look at earnings per share, dividend yield, what is the extent of the risk, what is the likely return, and of course, with investment, higher is better. You know, if you get more earnings per share, that means you're going to get bigger dividends. Okay, earnings per share, profit after tax, number of shares, divided by the number of shares. That's a big one, because if I'm going to invest in a company, I am definitely going to look at the earnings per share, because that earnings per share is going to determine how much of a dividend I get, and that's why I'm investing in them. the stock to go up, and I want to be able to get a dividend. Price earnings ratio, market price divided by earnings per share. And the market price is just basically whatever the stock is selling for. Okay? Amazon sells for about $2,000 a share. You can look at some penny stocks, and you can get them for as little as $2 a share. Okay, the higher the better generally for the company. Comparison with other firms helps to identify value placed on the market of the business. And what we mean by comparison of other firms, I want to give you an example. The automobile industry here in the United States, when somebody is thinking of investing in GM, Ford, or Chrysler, they're going to compare, okay, these price earnings ratio to each other. And they're going to see which one is the best one. Okay? Enterprise value, earnings before interest, taxes, and dividends. The higher the better generally for a company. It measures the operational performance of the firm. Okay? Are they doing really well? Because if they're doing really well, and this is high, okay, I'm going to be more likely to invest. And then dividend yield, ordinary share dividend divided by market price times 100. Higher the better. Relates the return on the investment to the share price. Okay? If I'm going to pay $2,000 a share for Amazon, I definitely want to get a fantastic dividend yield. That dividend yield is going to be determined on how well they're doing. Now, right now Amazon's doing very well, so the stock sells. Gearing, what's your financial position? Loans divided by capital. High gearing minus loans is greater than capital. Gearing ratio equals long-term loans divided by capital employed times 100. The higher the ratio, the more the business is exposed to interest rate fluctuations and to having to pay back interest and loans before being able to reinvest earnings. This can be something that you really need to look at, because the more long-term debt you have, the higher interest you pay. The higher interest you pay, you might not be able to take operational money and reinvest it in the company like you should be doing. So the company can grow. You know, there's an old saying, if you're not growing, you're dying. So this is something that investors look at quite deeply. Profitability, of course, is where it's at. We start businesses, whether it's a small business or a big one, to make money. And we look at profit margins, the return on capital, and higher the better, of course. Okay, we want huge profit margins if we can get them, and we want a lot of return on capital. Profitability measures, they look at how much the profit the firm generates from sales or from its capital assets. And what we mean by capital assets, these are big things. Cash, buildings, land, trademarks, patents, copyrights. It can almost be anything. It can almost be anything. And to kind of look at capital assets, I mean, can you imagine how much the Coca-Cola trademark is worth? I mean, we can all see that in our head right now, that trademark. It's worth billions because it's extremely recognizable and it's been around for over 100 years. Okay? Different measures of profits, gross and net. Gross profit is effectively total revenue, okay? Turnover minus variable costs of sales. That's gross profit, okay? Net profit is effectively total revenue, and that's turnover minus variable costs and fixed costs, which is your overhead. Variable costs, many times, are not things you can control very well, okay? It's just going to kind of happen on its own. It's kind of that independent variable. Yeah, it's going to go up and down no matter what you do. A fixed cost would be more something to do with overhead, like maybe rent. You know, your rent is locked in for 5 years. Or a mortgage payment that's locked in for 30 years. Okay? And these are things you need to look at. Gross profit, you still need to take out fixed costs. So really the one that investors look at is net profit. Because they look at net profit because really most of the costs and the expenses are already taken out. What's left, that's where they're going to pay you the dividend on your stock. gross profit divided by turnover times 100. The higher the better. Enables the firm to assess the impact of its sales and how much it costs to generate or produce those sales. Now, what do we mean by turnover? What we're meaning by turnover is inventory turnover. Sales. Are they turning over quick? Remember, if a product is sitting on the shelf, it's not making you any money. Okay, you need it out of there, you need it out in the store or on Amazon or Alibaba or whatever, and you need it sold because that's how you get your money. Okay, so we want turnover to be fast. A gross profit margin of 45% means that for every $1 of sales, the firm makes $45 in gross profit, which is not bad. Not bad. So those are things we need to look at. You'll see this a lot when they're looking at gross profit. Because the 45 is going to pay for the expenses, the dividends, the taxes, on and on and on. Okay? And that means you're going to get your investment back eventually. Net profit margin equals net profit divided by turnover times 100. Net profit takes into account the fixed costs involved in production, the overhead. Okay, these are the costs that don't really change. They stay all the time. Now, one good thing about fixed costs is that they don't fluctuate. The other thing about fixed costs that's not so good is that you've got to pay the same amount every month or every quarter, whatever it is. Keeping control over fixed costs is super important. Could be easy to overlook, for example, the amount of waste, minus paper, stationery, lighting, heating, water, etc. These things are expensive. We all as individuals, we pay these things. So, yeah, we know they're out there. Leaving a photocopier on overnight uses enough electricity to make 5,300 copies. Okay? And that's 1,934,500 per year. So it might be a good idea to turn that copier off at night. One ream is 500 copies. One ream equals $5 on average. Total cost, therefore, is $19,345 per year, or one person's salary, an entry-level person. Okay? This adds up, though, as time goes on. Remember, these numbers might seem small, but it adds up as time goes on. And this is money we can be using in other ways to make more money. Return on capital, profit divided by capital employed times 100. The higher the better. Shows how effective the firm is in using its capital to generate profit. What we mean by capital, guys, is cash and assets, equipment, vehicles, buildings, land, trademarks, all that stuff. Are we using those things to make money? Or are they just sitting there? Okay? An ROCE of 25% means that it uses every $1 of capital to generate $25 in profit. That's pretty good. Partly a measure of efficiency in organization and the use of capital. How well are we using all these assets that we have to produce money? Okay, because that's the idea. We need profit. Last but not least, we're going to talk about financial. Asset turnover, stock turnover, debtor days. Asset turnover equals sales turnover divided by assets employed. And this is, are you using your assets to generate profit correctly? Asset turnover times net profit margin kind of shows you the same thing. Okay? And remember, we're not going to buy any assets unless they're going to make us money. Okay? Stock turnover, cost of goods sold divided by stock, expressed as times per year. The rate at which a company's stock is turned over, how fast does it sell? You have people buying it, or is it just sitting there? Okay? If it's just sitting there, that's not good. Okay? If people are buying it in large quantities, that's good. That means you're doing well. That means they believe in you. Okay? A high stock turnover might mean increased efficiency. True, but depending on the type of business, supermarkets might have high stock turnover ratios, whereas a shop selling high-value musical instruments might have low stock turnover ratio. And there's a reason for that. Well, we need food, so we're going shopping all the time. So supermarkets like Walmart, that's a good investment. And actually, Walmart stock does very well. Okay? But if you're a shop selling high-value musical instruments, you've got to have a very tight target market, a very small target market. And you may have a very low stock turnover because not everybody's going to be investing. Okay? Low stock turnover could mean poor customer satisfaction if people are not buying the goods. Well, yeah, it could. A lot of businesses don't understand how important customer service is. Okay? We have to give the customer what they want, what they need, and it's extremely important. And don't think that it's natural to be able to do customer service, but it can be learned. So we need to think about this all the time. If we have a low stock turnover, people may not be happy with the kind of customer service that they're getting. Okay? And that can be a real problem. All right, I'm going to stop there. I wanted to thank you all. I hope you enjoyed the video, and I hope this helps you